Hello, everyone, and welcome to another YCharts webinar. I'm Joe Clevin, a product manager here at YCharts, and I'm joined by my good friend and colleague, Tom Joyce, who is one of our customer success managers here at YCharts. How are you today, Tom?
Joe, I'm good. Thanks for having me back on. I think this is our third quarterly review in a row, so looking forward to tackling another quarter with you in terms of the markets and economy.
Likewise, good sir. It is the third indeed. And as we do every quarter, today we're reviewing our latest economic update summary deck with visuals and data summarizing Q4 of 2023. And our hope is that this data can not only help you take a look at the quarter that was, but also help put a bow on 2023 and navigate whatever is in store for this new year. And we're extra excited about this particular quarter as we're about to show off our new and improved slide deck that contains several new slides with visuals and data points, all for your preferred use with your own clients and prospects. We'll be covering most of the deck on today's webinar in a slightly modified format that, like your favorite movie, is also modified to fit this screen. So be sure to download the full deck if you would like to join along. And I'll show you where to do that quickly for you YCharts clients out there. If you head to support and then insights and visuals under this content column, go to Insights and Visuals and click the Economic Summary Deck tab here on the left. You can download the deck in PDF or in PowerPoint format. And if you're not yet a YCharts client, no problem. You can also follow along as well by going to this page here and just got to put in your email and the deck will unlock for you here. We'll drop that link in chat for anyone that's not a YCharts client that would like to follow along and as well as get a deck for their own use. You can also head to our blog and click our recently published blog post that previews the deck and just put in your email here as well. And that will also give you access to the deck. And speaking of chat here, since we'll drop that download link there for you, we'd love to hear your questions as we go through the deck today. So submit them using the chat feature and we will answer them live during this webinar. 3 quick reminders before we go ahead and get started. Number one, just keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Number two is that nearly all of the data that we're reviewing today was published by various private and government agencies, and data is as of the end of Q4, December 31st, 2023, or the latest available data as of that date. And lastly, we will be emailing a recording of today's webinar and a copy of the full economic summary deck to all attendees. You can expect that in your inbox tomorrow, and this will also be available as a replay on our YouTube channel. All right, so with all of that said, let's get to the main event. We'll be covering slides from the Econ Summary Deck across these 4 sections. We've got market data, macro data, bonds and interest rates, as well as what seems to be everyone's favorite section, a few charts of the moment that summed up really what the quarter that was. So with that, I will pass it off to Tom to get us started.
Let's do it. Thanks, Joe, and thanks for that intro. For anyone who didn't follow that or joined late, feel free to reach out to your YCharts representative and we'll be able to point you in the right direction. Okay, so let's get into looking at the stock market. So breaking this out into US and global markets respectively, we can see that the US markets in Q4 all hit, the broader based indices all hit double-digit returns. Dow Jones just above 13%, S&P 500 nearing 12, and the NASDAQ nearing 14%. Towards the bottom of the chart, you can see the global markets, and we've got MSCI indices, emerging markets, world ex-US, and the EFA. Emerging markets was up nearly 8%, and the world ex-US and the EFA both breached double digits at around 10.5% respectively. On to our next slide here. We'll continue on, but we'll take a look at this rather than in Q4 form. We'll look at it from a full 2023 perspective. So what's great is across the board here with all 6 of these broad-based indices is they're all up at least double digits in 2023. NASDAQ paced quite considerably, nearing almost a 45% return following a tough stretch the years prior. But even still, the S&P 500 was up over 26%. And then after that was the EFA, the ex-US, the Dow Jones, and the emerging markets, all kind of together around anywhere between 10 to 18%. And this is a great chart here. Very instructive as to what has transpired over the last 5 years. So what we're looking at is drawdown for those same indices. That includes the NASDAQ, the S&P 500, et cetera. And if you take a look at this chart, again, 5-year time frame, I know it doesn't feel like it, but the 2020 pandemic pullback kind of looks like a blip on the radar here because we came back so quickly. Whereas if you look at what's transpired over the last 2 years, this is persisting, those drawdowns, except now as we've come to the end of 2023, 5 of these 6 indices are within 5% of all-time highs within the last 5 years as well. So you can see that, except for the emerging markets, which is still trailing, is about 23% off its high.
Absurd to think that, just like you said, Tom, it was a blip in the radar, and it's almost like those drawdowns are just in the rearview mirror now as we hit all-time highs.
I know.
And now let's take a look at some asset classes and see how these performed in the last quarter and beyond. So we look at the 3-month column here that looks at Q4 of 2023. US real estate was the top performer with an 18% total return, and that corresponds to the Dow Jones US Real Estate Index total return. All of these are, of course, available on YCharts. In second place, US growth was right there at 14.2%, and small caps up 14% as well. Interestingly, commodities was the only asset class that failed to post a positive return in Q3. They shedded 10.7% in the quarter, and they're also down over the full year 4.3%, as well as down 3.6% across the last 10 years. So certainly a lot of ups and downs for that commodities sector, even with that 3-year total return of 19.2%, definitely overshadowed by short-term performance and even longer-term performance on that 10-year scale. And another important chart we have here is looking at performance of portfolios with allocations of 80-20, 50-50, 20-80, as well as an all stock that is just the S&P 500. And we see here that over the last 12 months, kind of like Tom alluded to on the drawdowns chart from a couple slides ago, everything had a great 2023. The S&P 500 itself was up 4.2%. The 80-20 aggressive model that, as you can see right here in the right-hand column, comprises these holdings at these specific weights. 80% stock, 20% fixed income was up 17.8%. Even the conservative 20-80 was able to rise 7.8%. And over the last 12 months, most of these portfolios clocked in at all-time highs at some point.
Yeah, that's interesting. Diversification plays, that's for sure. Okay, one of my favorite charts in today's conversation, looking at index concentration. And of course, this has been a huge talking point over the last 12 to 18 months. And YCharts put out a lot of great content over the last 12 months regarding the S&P 7 and the 493 versus the S&P 500. We'll get to that chart on the right in just a second. On the left-hand side, I want to talk through the index concentration. So we've got SPY's top 10 holdings, SPY tracking the S&P 500, and then QQQ's top 10 holdings, QQQ tracking the NASDAQ. So when we're looking at the top 10 holdings for SPY, that comprises over 30% of the index. So nearly 1/3 is coming from those top 10 holdings. For QQQ, it's crazier than that. It's nearly 50%. So over 45% is coming from those top 10 holdings. So when you talk about index concentration, it's easy to see this here. Now, you could take this a step further for our YCharts users. If you wanted to compare the top 10 holdings of SPY from December 2023, from January 2014, you wanted to look at what it looked like 10 years ago compared to end of Q4 2023. You can make that comparison now within YCharts. We do have that data set. So please reach out to your YCharts representative. They will point you in the right direction as to how to actually get that data. Very interesting conversation to have. And then on the right-hand side, some of our attendees are likely familiar with this chart. So we've got the S&P 7, which is, again, that magnificent 7 that comes with Apple, Microsoft, Amazon, NVIDIA, Alphabet, Meta, and Tesla on a market-weighted level. Then we've got the S&P 500 in orange. And then we've got the S&P 493, so the balance of those non-Mag 7 holdings. And we can see what the performance looks like across all three. S&P 7 clearly blew it out of the water last year. S&P 500 stayed relatively steady in comparison to the other two. What's interesting about the S&P 493 is some of the pullbacks that it had. So you can see year to date at a couple of points in time, both in early 2023 as well as late 2023, was actually negative year to date. So I think that just speaks to how important those top 7 tech stocks are really, what they're doing to uphold this index, especially in 2023.
It's so true, Tom. It was arguably the top storyline of 2023, and it's continuing into this year as well. And for those of you that might want to get your hands on this chart and even put your own branding on it with which is something that you can do with YCharts, you can simply email us at support@ycharts.com, and our team will get you set up with that visual and your branding on it as well. If you've already done that or you plan to do that, I'm going to show you real quick in fundamental charts where you can ultimately access that chart. And if you just go to new fundamental chart here at the top and click open, and then click shared with me, and you'll see I have a lot of charts. I'm a little bit of a geek, but I have a lot here. And you'll see that we have this group called YCharts Marketing that my team helps put these together. And if you click that magnificent 7 versus 493, there it is. And so from there, you can add your custom branding. It'll appear here. You can change the colors, anything like that to your liking, and really make it your own for your own client communication materials. One last thing I'll highlight on the top 10 holdings data, we do have that in a historical mode as well. So if we go to SPY here, for example, and on this tab bar, click holdings, and you'll see the top 25 holdings as of a certain date. If you then click history, you can then go back to a certain month as well as a year and see a snapshot of what the top holdings of that particular ETF or mutual fund were at that time. So great snapshot tool to give you a sense of how these ETFs have really evolved with the weightings over time.
Yep, extremely popular use case.
Well, that was super to cover. And so let's get back on track and pivot from market data to macroeconomic data. And we'll start off with what's been a common theme as well, and that is inflation as well as wage growth. So let's see how inflation clocked in December of 2023. The US inflation rate was 3.35%, which is down considerably from its peak of 9.06% back in June of 2022. And core inflation has fallen with that as well, just about a little under 4% as of December, also down from its high of 6.63%. And on the bottom in brown, you can see that steady rise of the US CPI over the last 20 years with that big inflation bump that occurred in 2021, 2022. Now it seems like things are smoothing out to be a bit more steady from 2023, and we'll see if that continues to 2024 and beyond. But good to see for anyone that might be feeling the pinch in their pocket a little bit that that year over year inflation rate has come down from those highs. And so then pivoting to wage growth, we also see a steady rise in US average hourly earnings over the last about 17 years. This is since March of 2006. Now, inflation adjusted hourly earnings, on the other hand, has had a little bit more of a turbulent ride because of those inflation metrics. And for a while, we saw that real average hourly earnings were actually growing at a negative pace for a lot of 2022. But this turnaround now, after 25 consecutive year over year decreases, prior to May of 2023, it just logged its 8th consecutive monthly increase in December. So great signs for earners across the country to see an actual meaningful bump in their paycheck, in addition to what's written in the column there, that they're actually feeling the effects of it and hopefully getting ahead a little bit too. And then we'll also shift to employment. We see that the total number of jobs that are currently open far considerably down from 12 million, which was a big headline number also back in summer of 2022. Seemingly employers just couldn't get jobs filled, or there were a lot of people simply not looking for work. Whatever the case might have been, we've seen the number of job openings come down to 8.79 million as of December of 2023. And another great piece of employment news is that the unemployment rate continues to hover around those record lows, coming in at 3.7% in December, just above what it might be the all-time low of 3.4% that was logged earlier this year and definitely last as well. The labor force participation rate is getting closer to its pre-pandemic highs, clocking in at 62.5% as of December. Still a little ways to go to get to that 63.2% level that it reached before February 2020. But overall, that trend looks to be going up nonetheless.
Got it. So we'll keep the trend going on the economic data side of things. Another popular chart here is our leading indicators. And feel free to reach out to support at YCharts.com in order to access this heat map. We're happy to share that with you. Several different indicators on here. We're going to review a couple of them, but you'll be able to note the numbers as well. So as of Q4 2023 or as of December 2023, we can see the 10-2 Treasury yield spread is still inverted at negative 35 basis points. But what I want to call out here is that we are trending in the right direction. We've been, inverted since mid 2022, but we are heading in the right direction. Q2 of this year, or of last year, finished at negative 1% inverted, and then we trended in the right direction ever since then. But you'll also know this is back-to-back years now, and that hasn't happened in a while. We don't have that on the trailing 10 years anywhere negative back-to-back like that. So something to call out that we're still in that deep inversion space. Hopefully we'll come out of that soon. We can see the Fed Business Leaders Survey of business activity, still a pretty low number compared to what it was earlier, the quarters earlier in 2023. It's near what it was at the end of 2022 on an annual basis. Same idea with Philly Fed Manufacturing Activity Index, still pretty low, but trending in the right direction. Along with trending in the right direction is the US Index of Consumer Sentiment. So that's updated on a monthly frequency, and we did see a slight increase quarter over quarter. And then towards the bottom, I think some slightly good signs. US housing starts slightly increased. US building permits slightly increased. Still down year over year, but on a quarter over quarter basis, trending in the right direction. And then the change in retail sales increased drastically. Of course, Q4 is a massive time for retail sales. Makes sense as to what we were seeing there. Okay, so GDP and public debt. So right here, we are looking as the data as of Q4. And we can see the US GDP was nearing 28 trillion. And the real GDP, quite separate from that, nearing 23 trillion. So, of course, we had the inversion between GDP, nominal GDP, and real GDP around the great financial crisis. You can see where that orange and purple line crosses. And now we're going the other way, where purple is really taking the increase, the nominal GDP, whereas real GDP slightly starting to flatten out over the last couple of years. And then down below, we have quarter over quarter GDP. And that's going back to 1947. So, of course, that's a pretty lengthy data set. So we've got a lot of numbers to work with there. And the average quarter over quarter is 6.5%. We clocked in for Q4, 4.8%. And then on the next slide, we'll be taking a look at public debt. So public debt here is going to be looking at north of 33 trillion when it comes to the US public debt. And then as a percent of GDP, it's still extremely elevated. So it's at 120%. We've been floating around that number for about a couple of years now, since just after the pandemic. You can see it's been increasing over time for about the last 40 years, but breaching that 100% marker is certainly a telltale sign. So we're starting to flatten out. We're no longer decreasing. We are flattening out around that 120% marker, something to look out for moving forward.
Super. And so then pivoting to housing, we see here another big storyline was mortgage rates this year, with the Fed raising at 75 basis points, 50 basis points, so on and so forth. That brings rates up across the spectrum, and mortgage rates were not immune to that either. The 15-year mortgage rate ended 2023 at 5.93%. The 30-year ended at 6.61%, which are still very elevated levels compared to the 2s and 3s that perhaps some new and very lucky homeowners might have financed a couple years ago, but have come down a little bit from what was 7 or maybe even 8% not too long ago. Unfortunately, in a negative sign, that has taken a toll on the number of new mortgage originations, which came in at 444 billion for the most recent quarter. And the amount of mortgage originations that were refinanced also was at a low of 18.24%. So we can definitely see the impact of higher mortgage rates when we look at mortgage originations and people choosing simply not to refinance. And continuing with the housing data trend, this is all National Association of Home Builders and Wells Fargo data points here. And like we saw with mortgage rates and originations, the traffic of prospective buyers has plummeted as a result, as well as single-family homes' present sales conditions for currently and in the next 6 months, as well as the NAHB and Wells Fargo Housing Market Index. The traffic of prospective buyers is bouncing at that 24 level, which it did around the end of 2022 to the start of 2023. And we're seeing those plummets happen again, once again, because of those high mortgage rates. And lastly, one more contributing factor to those rates, the housing prices just keep going up, believe it or not. On the right-hand side, the median sales price for new houses sold isn't at its peak of above 480,000 like it was not too long ago, but as of 12/31/23 came in around $435,000, that median price for new houses sold. On the existing home side, roughly around 383,000, which also is below its peak, but you see a little double top there, which might make you wonder, could we go back above that level if mortgage rates were to fall? Or could things head lower in terms of housing prices? On the left-hand side, we definitely see the slowdown in sales traffic for existing homes. What was above 6 million in 2021, 2022, has now plummeted down to 3.78 million in the latest data available. And new single family houses sold was once above 700,000. And around 2020, when we had those ultra low rates, was above a million, now down to around 590,000. So we definitely see the ripple effects across the housing market. And everyone might be wondering the next step could be, will those housing prices take a meaningful fall downward?
Yeah, completely, Joe. And this is a real applicable conversation that our clients are having with their clients. Our YCharts users, our financial advisors are having this conversation with their clients and their clients' children, because 20, 25, 30, 35 years ago, those rates might look a little similar. The prices do not. So the prices keep increasing, which is making for a really difficult conversation to have. How am I setting aside this money? A lot of parents might be, a lot of financial advisors, their clients might be setting aside money for their children. So these charts can really help kind of depict what's happening in the housing market. What can we see moving forward? How can we adjust for this in our financial plan? So these are charts that can help facilitate those conversations. Excellent. All right, on to the broader network of consumers. So we can see sales and consumer sentiment, sales being at the top, consumer sentiment being at the bottom. So this is kind of similar to the GDP versus or nominal GDP versus real GDP slide we looked at earlier. Purple and orange at the top. We've got the US retail sales on a year-over-year basis as of the end of 2023 was just north of 4.7%. But you can see that gap really widened over the last couple of years with the real retail sales, that inflation adjusted figure. It's starting to come closer together, which is great to see as we know inflation comes down. But compared to the rest of the chart, that's a pretty wide section in the chart looking around 2021, 2022. Towards the bottom, we've got the US Index of Consumer Sentiment. So, how is everyone feeling about where we're at currently? Well, as you can see from the chart, the average is about 86, 87. We are well below that. We're trying to claw our way back. We bottomed out somewhere in 2022. We've been trying to increase ever since. We're hovering around just south of 70 right now. But hopefully we'll be able to get back. Since the pandemic, we've breached that average line only once. All right, so that wraps up our macroeconomic data. Now we'll go ahead and take a look at our bonds and interest rates. Okay, so here, I know it's 1:28 Central Time, so I'm sure that maybe this number changed, maybe it didn't, but we've got the Fed funds rate here. You can see it's flattened out over the last several months after an increase. Worth noting that the upper limit of the Fed funds rate was targeted at 5.5%, but the effective federal funds rate is sitting at 5.33% right now. Things may have changed since we started this session, but that's where things ended as of 2023. Onto another very popular chart. So this is looking at the S&P 500 level versus the 10-2 Treasury spread. We took a look at this earlier when we talked about the inversion. Just see we have bottomed out already, but since July of 2022, we have been pretty far down here. And that's the longest inversion that we've had in this entire chart. And this chart dates back to 1988. So we keep living in this inversion of the 10-2 spread. The S&P 500 obviously was very correlated to that in 2022. As we were bottoming out, they moved at the same rate. As we're increasing that inversion, you can see the S&P 500 continues to climb as well, ending just shy of 4,800 for 2023's calendar end year. And then lastly, this is an excellent chart. And Joe, I'll ask you to show this and demonstrate it later on here in just a moment. But this is our yield curve summary. So this is looking at everything from a 1 month to a 1 year to a 10 year to a 30 year. And we can see what the rates look like. Now, you've got the table on the left that demonstrates a lot of what we're seeing in the chart on the right. So since 2020, we know that those rates have increased. They came pretty close together, squeezed together. It does look like for the midterms and maybe longer term horizons, we did already top out some point middle of Q4 2023, and we've since come back down. The 1 month rate did increase slightly on a quarter-over-quarter basis. You can see it was more or less flatlined. All of these other timeframes came down on a quarter-over-quarter basis. So everything is starting to be pulled back a little bit in terms of rates, basically over every time frame.
Good view on this, Tom, and we'll see if that 10-year ever eclipses 4% again. It might be currently. I haven't checked in a little bit as this is of 12/31,
right?
But we can actually go take a look right now because it's really easy to populate this chart within YCharts thanks to our templates that we have. So here in fundamental charts, if you click new fundamental chart once again, then on the drop down, just select new from template. We have several categories of these pre-built charts at your disposal. So we've got Animal Spirits, Michael Batnick, Ben Carlson are on here a lot. We've got a lot of their favorite charts on here. Charlie Bolello is another great name who is doing his own folders here with us too. We also have this one that we made in-house, which is our Econ Summary Deck template library. So just scrolling down to the bottom here, we can click the yield curve summary, and that will bring that chart into view right here. And we have it preset in the last 3 years. I'll also just show the legend on the chart to save some room. So this is a last 3 years view, and it does look like the 10% or the 10-year is above 4% once again. We can widen that out by clicking the 10-year. And now you have a 10-year view showing how some of these yield curve, these inversions occur and the normalization, kind of the ebbs and flows of that. You can even go all the way back many, many years to take a look at well over time here. But this is a really easy way to just within a few clicks, get these information on your screen in front of clients, in front of prospects, as well as colleagues. So just a good little thing to point out here. And moving on to our final segment, which is often our crowd favorite, the charts of the moment. So we have 5 of these this quarter, and let's go ahead and see what they are. The first one is the end of the bull market. Kind of like you had pointed out in the earlier part of this, Tom, we saw the drawdown charts coupled with the percent gains over time. And it looks like 2020 as well as 2022 are firmly in the rearview mirror. We see that bear market threshold was crossed 3 times in the last 3 to 4 years or so. And we saw that there were these bottoms here on June 17th, September 30th, and October 13th of 2022. And we got as far high on a drawdown basis of just being down 4.2% this July, about actually 6 months ago to the date. Now we're just within 0.5% of an all-time high as of December of 2023, but I think we've breached that now. So this chart is a great way that you can also use our annotations feature to highlight thresholds like a bear market or a bull market, look at technical indicators, which you can do on a separate feature. That's our technical charts tool, as well as add notes and lines annotations to really drive emphasis to some of these spots. And a couple other that have been fan favorites are these winners and losers scatter plots. This here shows the entire constituency of the S&P 500. And in green is every constituent that had a positive Q4. In red is every constituent that had a negative Q4. And that triangle is the S&P 500 as a benchmark. So we see that 419 S&P 500 stocks were in the green and 84 were in the red. So in other words, about 5/6 of the S&P 500 had a good quarter. The best was Expedia Group, which finished up 47.3% in Q4, and the worst was Hasbro, posting a negative 22.8% slump in Q4. And on a similar note, we also have the full year winners and losers. For 2023, we had 322 green S&P 500 companies. We had 181 red S&P 500 companies. And so in other words there, about 2/3 of the S&P 500 had a good year. That was 64% versus 36% that did not. And who were the best and worst performers in 2023? The best was NVIDIA, which is all the way out here on its own little island, which had a whopping 238.9% increase. And Meta Platforms was a close second at 194.2%. In third place, surprisingly enough, was a great bounce back by Royal Caribbean right here, which surged 162% in 2023 after slumping 63% in the last 3 years. That's between 2020 and 2022. We do have to take a look at the worst performers, though. That was Enphase Energy, FMC, and Dollar General, which ended the year down 50.1%, 49.5%, and 44.8% respectively in 2023. And if you'd like to get access to this visual once again, please talk to us at support@YCharts.com, and we'd be happy to set you up with the data needed to get this chart in your account. And for those of you that have already taken that step, we thank you and do watch for more great content as we pump it out. But if you go to Scatterplot and you click open, just like we did with the S&P 7 chart, click shared with me, and that 2023 winners and losers chart will appear here for you, exactly like we showed it to you in the slide deck. And of course, your custom branding will appear, your logo will be in the left-hand corner, and you can download this chart with just 2 clicks to then communicate to any clients or prospects in your own material.
I love this chart. I think it's so telling. Even just to have a conversation around, I mean, this could be a simple conversation around diversification, looking at the individual stocks or taking the 10% that you're going to get, or the 15 or 20% that you're going to get from the broad-based ETF that tracks that index, which is pretty fascinating. On to our next chart of the moment, which is manufacturing, contraction or expansion. So we've got 3 separate charts here. And we're going to be taking a look at the US ISM manufacturing at the top. So we'll start there. So the horizontal line is going to be the 50 mark, and above that 50 mark indicates expansion. Below that 50 mark indicates contraction. And we have been there for several months now. We've been actually all of 2023 we experienced in a technical contraction in terms of the US ISM manufacturing PMI. Down below, we have the US manufacturing construction spending chart that seems to ever increase. But look at since about 2022, it's remained extremely elevated. So it had a really rapid increase. It seems to be tailoring and flattening out here just a little bit. But that huge increase coming in, starting in 2022, we now remain elevated at that increased level. And then lastly, we have U.S. manufacturing new orders. So after a dip following the pandemic, of course, we also saw a pretty steady increase over time. And since mid-2022, early to mid-2022, we've been stalling here a little bit. We're still remaining elevated, just shy of 600 billion in terms of the new orders, but we have been hovering more or less around that number for about 2 years now. All right, and then lastly, we'll be taking a look at the yield curve and the recession probability. So despite 2023's performance, and the start to 2024. Of course, this is still a conversation to be had. What's happening with the market, the economy, are we expecting a recession? So we've got the Treasury yield curve, which we've already taken a look at on the left-hand side. We know where we sit there as of the end of Q4 of last year. But then we can see the US recession probability as well below that Treasury curve. It's been increased considerably. We know in 2023, that was a pretty low number, but looking out into the future, we can see that is ahead. That's looking ahead in 2024. Those numbers are very elevated compared to the recession probabilities that we've seen in the past. So definitely something to consider. And then on the right-hand side, again, another recession probability indicator. This is the Estrella and Michigan probability indicator. The last time we held this session, it was coming down, and we thought, okay, great. That has since spiked. So we're back up towards about 63%. We haven't seen the numbers that we saw earlier last year, as well as late 2022 when they were really high, but we are trending north again. So hopefully that starts to peel back a little bit. But as you can see, we haven't had these high numbers in a long time. Think about the 90s recession, think about the dot-com, think about the great financial crisis, even the pandemic. We haven't been qualified into a recession right now, but those numbers are higher than they've been since the 80s.
And will they happen, Tom, is what I think everyone is going to be wondering going into 2024. On top of everything we covered here, this could certainly be first and foremost. Will we have another gray bar show up in the history of charting here?
Right.
So a bittersweet way to end with maybe a recession probability, but we'll see if we can avoid it coming down this year.
That's right.
And that will do it for us. Thank you for joining, everyone. We hope you enjoyed this review of the latest economic data, market trends, charts of the moment, all in our quarterly economic summary deck. We do invite you to submit any questions you have at the last minute here with the couple minutes we have left. For those of you that joined late and were wondering where you can download a copy of this deck, for you clients of YCharts out there, if you head to support at the top and then under insights and visuals, you can download the economic summary deck right here, as well as access past versions on the left-hand side. If you are not a client of YCharts, you can still get the deck. Good news. We'll post this again in the chat for you, but you just head to this link, pop in your email, and we will give you a copy of the deck right here on this page. And lastly, for you professional tier clients out there, if you haven't seen this in our report builder tool yet, which you can access by tools and then report builder here, you can actually create your own economic summary deck using a report builder template. So by clicking create new and then new from YCharts template, and under presentation, we have the econ summary deck here as a template for you. And by no means do you have to save and use this exact template. It's really easy to add new pages. And here you can pop in charts, scatter plots, tables, even your own disclosures to help satisfy those compliance requirements. All of that can be added here and then simply saved with a name and generated here for your preferred use. And all of this, of course, will come with your own custom branding, logos, color schemes, disclosures like I mentioned, etc. So be sure to check that out. And if you're not a professional tier user, please talk to us because we'd love to get you set up with some of these great new features. And it looks like we have no questions in the chat. So at 1:45 Central, I will conclude it there. One friendly compliance reminder, none of this is investment advice, and YCharts is not acting as an advising party regarding client funds in any way. So once again, keep sure that in mind. And Tom, thanks again for doing this as always. It's always a pleasure. And for all of you that joined, we thank you for spending your hour with us. And we hope to see you next time on a YCharts webinar. Take care, everyone.